QE is going to come when the bond market, I guess to use Trump's words, really gets yippy. But, maybe
we're already higher than when he first said it was getting yippy.
Yeah, I mean, it's about the same. It's not, it's because we had gotten to about 4.5 on the 10-year and about 5 on the 30-year. And so that's about where we are. But those are still low rates. They're not as low as they were. But if you go back, since the end of this Second World War, those are still low rates that we've got. And considering how much
amount
debt
of debt we have, though.
We should have higher rates. When the more debt you have, if somebody goes to borrow money and they don't have a lot of debt, and you go to a bank or a lender and you've got a pretty good personal balance sheet and you want to borrow money, you'll get a certain rate. But if somebody else comes and they're loaded up with debt and they want to borrow money, they're going to pay a higher rate because they're a greater risk. They have a lot of debt, so that means that they may not be able to pay it back. So you don't want to loan money to somebody who's already broke. You want to loan some money to somebody who can pay you back, easily. And so we're broke right now. We have trillions and trillions of debt, yet we still have interest rates as if we were, solvent, which we're not. But I think that the position we're in now is that if the Fed cuts rates again, long rates are going to rise again, just like they did before. The Fed cut rates to about 100 basis points. But then long-term rates rose 100 basis points. So the long-term rates did the opposite of what the Fed wanted. And I think that if the Fed goes back to rate cuts, the long end is going to go up. And that's going to be because the bond market is going to be worried about the inflationary impact of and the impact that it's going to have on the dollar, because a lot of the holders of our debt are foreign. And so when they look at our debt, they don't look at it from the prism of a dollar. They look at it from their own currency. And so if you're European and you've got money in US treasuries and you're getting 4 or 5%, but you're a euro-based investor, and you think, well, the dollar could drop another 10 or 20% this year in terms of euros, why would you want to just hold those treasuries? You're just going to lose a lot of euros holding treasuries. And so I think you're going to see more selling in the bond market as the dollar goes down. In fact, what you're seeing now is foreigners are selling all their U.S. assets. They're selling their U.S. stocks, their U.S. bonds, their U.S. dollars. U.S. stock market's been overvalued for a long, long time now. And now, finally, people are starting to notice how expensive our stocks are. And now that the dollar is falling, it makes it even riskier for foreigners to own those stocks, but particularly the bond. Because at least with a stock, you can say, well, the stock could grow and their earnings can grow. And so even if the dollar is going to drop 5 or 10%, I can still make more if the stock grows by 20 or 30%. But when you're buying a bond where the most you can get is the coupon, and the coupon's 4 or 5%, there's no way to offset the foreign exchange loss. So when the bonds really start to get hit and interest rates rise, and if we start to see especially a big upturn in unemployment, right? So now the economy is weakening and interest rates are rising. Even if inflation is rising, the Fed is going to go back to QE because it's going to be the only way that it can try to, lower those rates, because rate cuts won't work. They're going to have to go into the market and buy the bonds that nobody wants. But the problem is, in order for the Fed to buy the bonds that nobody wants, it has to create the dollars that nobody wants to pay for them. And so the more money the Fed prints to buy bonds, the worse off bonds become as an investment, because now they're creating more inflation to buy bonds that people don't want because there's too much inflation. But now there's even more. So it becomes a self-perpetuating spiral. The more bonds the Fed buys, the more bonds the rest of the world wants to sell. And, if the Fed is just buying treasuries, well, what happens to the mortgage-backed securities? Well, they get, so now they got to buy those. But what about corporate bonds? Are they going to start buying those? Municipal bonds? Because, interest rates are just going to spike. And our economy is based on two things. It's based on artificially low interest rates and cheap import. And if prices are soaring because we can't import stuff cheap anymore, either because of tariffs or a weak dollar or a combination of both, and interest rates are soaring because we have so much debt and the rest of the world isn't willing to finance it, then our whole economy that was built on that foundation collapses. And then the risk is that the inflation runs out of control. And then you get into a hyperinflation scenario, which, is the worst of all possible outcomes.
And here's where things start to spin out of control. You have the Federal Reserve trying to maintain the illusion that this economy is stable, that everything is just peachy if you squint hard enough and ignore all the smoking craters across the bond market. And I'm going to say something that might sound blunt. Interest rates, as they stand today, are still artificially low relative to the absolute mountain of debt we're sitting on. That's the absurdity of this moment. It's like giving a junkie just enough methadone to keep him upright, but not enough to keep him from collapsing. Let's say you're a foreign lender, holding trillions in treasuries. What are you thinking right now? You're probably looking at the US balance sheet, if you can even call it that, and realizing it looks more like Enron's income statement. You're staring down the barrel of a currency losing value faster than it's being printed, and a debt-to-GDP ratio that's one recession away from catastrophic collapse. Moody's just issued their usual sleepy time downgrade warnings, but let's be honest, 134% debt to GDP by 2035? Try 200% when you factor in the off-balance sheet stuff, the unfunded liabilities, Medicare, Social Security, interest payments, all ballooning. It's like watching a slow-motion train wreck and pretending the screaming passengers are just enthusiastic. And yes, the Fed is absolutely going to return to QE. People act like it's some theoretical possibility. It's not. It's baked into the cake. Because the moment unemployment starts rising and the equity markets turn over, that same panic we saw in March 2020 is going to surface again. Except this time, the Fed will have a credibility problem. Why? Because every dollar they print now will scream inflation. It will scream, "We don't know what we're doing." You cannot rescue the bond market from collapse by printing money to buy the very debt that's causing the collapse. That's not monetary policy. That's circular insanity. But this is where it gets almost diabolically poetic. The more treasuries the Fed buys, the worse they look as an asset class. Because you're telling the world, nobody else wants this garbage, so we're going to buy it ourselves. Imagine being at a garage sale and watching the seller buy his own junk just to keep up appearances. That's the Fed right now. And look, foreign holders are not stupid. They're not going to sit back and say, "Yeah, we'll hold your treasuries, even though your dollar's falling, your inflation's running hot, and your own central bank is panic buying your debt." Nope, they're already leaving. According to recent TIC data, China's holdings of US treasuries have dropped to the lowest level since 2009. And it's not just China, Japan too. Even US allies are offloading this stuff, shifting into tangible assets, commodities, gold, energy infrastructure. Smart money knows this bond market is a burning building with only one exit. Let's take gold. Historically, gold moves inversely to interest rates. But now, gold is moving with rising rates. Why? Because it's not the nominal rate that matters, it's the credibility of the institutions behind it. And right now, there's none. As rates rise, the market isn't saying, "This is a strong economy." The market is saying, "We don't believe in your fiscal discipline." There's a subtle difference, and that subtlety is what separates monetary stability from collapse. Meanwhile, the LBMA and COMEX are experiencing delivery pressure unlike anything we've seen before. You've got month-over-month gold imports into the US surging. The US, historically a net exporter, is now a net importer. What does that tell you? Someone is scrambling to get their hands on physical metal. And it's not mom and pop stacking silver eagles. This is central bank behavior. Repatriations are happening quietly. Hungary, Poland, even Germany are pulling metal back from the Bank of England. Why? Because the old custodians, the New York Fed and the BOE, aren't seen as neutral anymore. They're seen as compromised. Now let's look at the canary in the coal mine, silver. Let's just be real for a moment. Silver is about as undervalued relative to gold as it's ever been in the last half century. Historically, silver trades at about 2% of the price of gold. Today, it's closer to 1%. And when that reverses, and I mean when, not if, silver's price won't just rise, it'll melt faces. We're talking the potential for a 2x move just to hit the median. But here's the kicker. Silver never outperforms gold in downtrends. If silver is outperforming, both metals are rallying. So if you see silver break out, expect gold to come with it. And the broader implication is a total repudiation of fiat credibility.
I think there'll be demolition. I don't think it's controlled in any way. Look, I mean, revaluing gold, our official value, I mean, doesn't change anything. I mean, if you just say, okay, we're going to count our gold, instead of saying it's worth $42 an ounce, we're going to say it's worth $3,300 an ounce. That's just an accounting. It means nothing because, we're not doing anything with the gold. And if the U.S. government was going to sell the gold, it wouldn't sell it at $42. It would sell it for the market price. So it doesn't change anything. There are people who think, well, this gives us extra money to spend. No, it doesn't. It doesn't give us anything. Senator Loomis says, well, let's revalue the gold and then use the money to buy Bitcoin. What money? There is no money. There's just the gold. You don't get any extra money. But if what she's saying is, well, let's use the gold and somehow print more money. Let's have the Fed print up a bunch of money because we've now officially recognized what the gold is worth. And then we're going to take that new money that we just printed and use it to buy Bitcoin. It's like, okay, let's create inflation and buy Bitcoin, right? Why would we do that, right? Why would we just debase the currency just to go out and buy Bitcoin? So it doesn't solve any problem. The only thing that would make sense about a revaluation of gold is if we're going to maybe back on a gold standard, have an official devaluation of the dollar, including of our debt. Because if we were to say, okay, gold is now $20,000 an ounce, and we're going to repay our debts in gold at $20,000 an ounce, right? So now, we've basically defaulted on a lot of our debt without really defaulting because we're going to pay it off in gold. And we just said that the gold is now worth 20,000 or 30,000 an ounce. So we wipe out 90% of our debt. But it doesn't even make sense to do that unless you're going to peg the dollar to gold and maintain that. But, at this point, and initially, of course, the dollar wasn't pegged to gold. The dollar was gold. I mean, that was the literal definition of a dollar. A dollar was a weight of gold. That's what it was. It was a way to measure gold. If you had a certain quantity of gold, it was called a dollar. That was the legal definitions. Gold was our money. Our money wasn't backed by gold. Our money was gold. What we eventually did is we created currency that was backed by money. But the currency was never money. It was a money substitute that you could use instead of money because it was more convenient than money. But what gave currency value was the money that backed it up, which was gold. So if we were to go back on that standard, yeah, that'd be great. And we can't do it unless we devalue the dollar officially and reprice gold. But I don't see any appetite in Congress to do that because that would mean they'd have to cut spending. And so, but they're not cutting spending now. So why do they want to go back on a gold standard that would force them to cut spending? The reason we went off the gold standard is because politicians wanted to spend a lot of money that they didn't have. Gold was preventing them from doing that. And, when I hear people in the crypto community say, oh, gold didn't work, gold failed. Gold worked perfectly. That's why the U.S. government abandoned it, because it was doing its job. It would have stopped them from deficit spending. It would have forced politicians to make difficult political choices that they didn't want to make. So instead of making those choices, they chose to leave the gold standard, right? But that doesn't mean that gold failed. That's people, human beings failed, right? And Bitcoin doesn't fix that. Donald Trump has made it clear that we can't have these trade deficits. And okay, that means we're leaving the dollar's reserve status.
Let me take a step back and hit this home again. What we're witnessing, folks, isn't a blip or some temporary rate cycle or regional disturbance. We are watching the foundations of the global monetary system realign in real time. And what's amazing, really almost comedic, is that so few people see it. The financial press, still stuck on whether the Fed will cut 25 basis points in September. CNBC is busy trying to interpret Jerome Powell's tie color like it's a secret code. Meanwhile, the world is moving past the dollar, and fast. Let's talk about that dollar for a moment. The petrodollar, once the bedrock of U.S. financial dominance, is unraveling. And no, it didn't start with bricks. It started with arrogance. It started when we weaponized the dollar by locking Russia out of SWIFT, by freezing sovereign assets. That was the moment the global South looked around and said, wait, that can happen to us too? And from that moment, the game changed. Countries began making calls. Deals got signed. Currencies started flowing around the dollar. The Saudi-Russia-China triangle isn't theoretical anymore. It's operational. Saudi Arabia, the backbone of the petrodollar system for 5 decades, just let its petrodollar agreement with the U.S. expire. No renewal, no extension. It just expired quietly. Think about what that means. They're no longer obligated to sell oil exclusively in dollars. And guess what? With the infrastructure already in place, from China's digital yuan to Project M-Bridge, they don't need to. As I said before, M-Bridge settles cross-border transactions in 7 seconds. That's not theory, that's real. That's tested and already adopted by 10 ASEAN nations and 5 Middle Eastern powerhouses, including, yes, Saudi Arabia. And you think they're going to go back to the old system of waiting 3 to 5 days for settlement through New York? Routed through JP Morgan, denominated in dollars? Please. And while that's happening, what's the U.S. response? Are we building out hard infrastructure? Are we stacking metals, shoring up reserves, reducing debt, or even, dare I say, living within our means? We're debating whether student loan forgiveness counts as inflationary. We're still printing money like the ink is free. We're talking about another $1 trillion deficit with interest payments projected to hit $1.7 trillion per year by the end of the decade. That's 100% of tax revenue just to pay the interest. Forget the principal, forget defense, forget roads, just interest. And guess who knows all this? China, India, Saudi Arabia, even our so-called allies in Europe. They're not stupid. They see the math. They see the Fed quietly buying $43 billion in treasuries in 1 week and calling it not QE. They see the bond auctions failing, the bid-to-cover ratios dropping, the yields spiking. They see Moody's issuing debt warnings only now, when anyone with a spreadsheet could have told you 5 years ago we were heading for a fiscal wall. Let me read you something from Vince Lanci that made me chuckle. Painfully. It's like 2 drunk guys trying to hold each other up so neither falls over. That's the US and the UK buying each other's debt while pretending it's a sign of strength. It's not strength, it's fragility, it's desperation dressed up in a suit and tie. And that brings us back to gold. Gold has no counterparty risk. You don't need to trust the issuer because it doesn't have one. And the central banks know that. That's why they've been buying it hand over fist since 2018. But what's changed is where they're storing it. We've seen mass repatriations. Germany brought its gold back from the Fed and the Bank of England. Hungary, Poland, Turkey, same story. The message is clear. If you don't hold it, you don't own it. Now here's where the rubber hits the road. The gold and silver markets are being drained. The LBMA and COMEX. You can practically hear the pipes rattling. In silver, the float, the unencumbered ounces, is under 300 million. That's a single day of global paper trade volume. That's not a market. That's a leveraged illusion. When SLV and the ETFs say they're backed by bullion, they don't mean your bullion. They mean someone else's, as long as nobody asks for it at the same time. And guess who is asking for it now? Central banks, sovereign wealth funds, not retail, big money, smart money. The kind of money that doesn't flinch at 2,400 gold or 35 silver because they're not looking for a trade. They're looking for a lifeboat. There's a beautiful quote I love, and I keep coming back to it in moments like this. You go bankrupt slowly, then all at once. We are at the doorstep of the all-at-once phase. The signs are there. Gold rallying alongside rising rates. That breaks the old narrative. Silver breaking resistance while the S&P wobbles. That's new. Miners starting to outperform gold itself. That only happens at the tail end of bear phases, when bull trends are starting to explode. And silver? I'll say this clearly. Silver is going to obliterate its 2011 high. $50 won't be resistance. It'll be a speed bump. When it breaks $36, the chart guys will wake up. When it breaks $50, the institutions will wake up. When it breaks $70, the media will start asking questions. And by the time it's at $100 or more, because yes, I believe we'll see triple digits, you'll have missed the big move. The industrial side of silver only adds fuel. The solar sector is growing at breakneck pace. New tech demands more silver, not less. India just announced record imports of silver for industrial use. Add in green energy mandates, electric vehicle expansion, and the geopolitical move toward resource nationalism, and you've got a perfect storm. But here's the twist. None of those demand catalysts are why silver will spike. They'll just justify it after the price explodes. The real reason silver is going to soar is because it always does, when faith in the system cracks. And folks, that crack is now a canyon. Look at the LBMA quietly moving from T+1 to T+8 on settlements, citing a shortage of trucks. If you believe that, I have a bridge to sell you in a fiat currency. That's not a logistics issue. That's a supply issue. That's a confidence issue. That's a pre-default issue. And we haven't even talked about gold's monetary resurrection. The Shanghai Gold Exchange going global, setting up shop in Saudi Arabia, building out vaults in Asia, connecting to the M-Bridge network. This is the skeleton of the next monetary system. Gold won't just be a hedge anymore. It'll be money again. And it won't be decided at the G7. It'll be decided in the East, with the backing of commodities, energy, and actual production. We are at the end of this 50-year monetary experiment. The era of infinite debt, infinite paper, infinite confidence, it's over. What comes next won't be declared on a stage. It'll unfold silently, one BRICS trade agreement at a time, one treasury auction failure at a time, 1 ounce of repatriated gold at a time. So my message to everyone listening is this: stop thinking in dollar terms. Start thinking in value terms. Because that's the great shift underway. Real wealth isn't about digits on a screen. It's about what holds its value when trust dies. Gold is that. Silver is that. Physical, tangible, sovereign-controlled. Not promises, not contracts, not derivatives. So stack accordingly, think long-term, and understand this. In a world unraveling by the day, owning the truth is the only protection that matters. Because gold is truth. Silver is truth. And everything else is just noise.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.